Good morning, everybody. Happy Thursday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed, we do. Lots of big things going on in all corners of the world. We have some big Federal Reserve decisions. What does it mean for now? What does it mean for the future? And also some new rankings about just how poorly the U.S. fares in terms of rights for workers. No big surprise there. Also some new developments with regard to Ukraine. A lot of pressure being brought to bear on the Biden administration to lay out a specific path and timeline for Ukraine to enter NATO. Doesn't seem like a great idea to me, but we'll talk about it. Also, some new developments on the third-party front, both some polling and also Cornel West is switching to the Green Party, and the White House is looking to block a potential no-labels bid. Excited to bring back the panel.
It's back.
Long awaited. Going to be in studio. We've got two great guests. Super excited to talk to them. One who is all in for Trump, one who is all in for DeSantis. We will respectfully hear their views and what they have to say.
We'll air it for the audience.
Exactly.
Yeah.
But before we get to any of that, thank you guys so much for the incredible comments and your excitement and enthusiasm about our new home here. We're still working everything out to make sure the shots are perfect and it looks exactly the way that we want to. But I have to say, watching back at some of the show, it looks amazing.
Oh, it looks amazing. It's already been such a massive improvement. We're doing a little tinkering here and there. Everyone's having a lot of fun with the camera angles, as you can see, where to look, what to do, how to dial the lights. And that's kind of the fun part of all of this, is that this is a completely built studio by you guys. You know, our premium subscribers, you helped us out. We have a very small team relative to the hundreds of people who work on these over at the mainstream media. But luckily for us, that's the way we prefer it. So breakingpoints.com, if you're able, you can help us out with our expansion and continue all that. Also, we've got our great new merch shelf on YouTube for our YouTube viewers. It should be right there below all of our videos. Everything that we sell is made in the USA and in a union shop, which we're very, very proud of. So anyway, take a look. We got it. It's all been beautifully designed, our beautiful new logos, which you can see everywhere. I'm told the bucket hat is selling very well.
Is
much
it for
to our
real?
Consternation, Krystal. I did wear a bucket hat. I was in Lake Travis in Austin over the weekend, and I got to be honest, 100-degree heat, and you're in the middle of the lake. It does have a function. It does have a use. So I did wear the bucket hat, even though I've crapped all over it here on Breaking Points. I was like, hey, look, it works. It works. All right, let's talk about the Fed.
Can't argue with results there.
You can't.
All right, so let's talk about big decision taken from the Fed. Yesterday, they decided to hold interest rates where they are, but there was a bit of a surprise in their announcement. Let's put this up on the screen. So they're going to hold rates steady for now, but they say two more are likely coming later this year. Let me read you a little bit of this. The market's apparently surprised a bit by the expectation of more rate increases. There's a quote here in the CNBC article from some trader analyst dude who says people expected a hawkish pause, and they got a very hawkish pause. Given the strong labor market, the Fed has room to crush inflation, and they don't want to miss their chance. Go ahead and put the next piece up on the screen. This is part of what informed their decision-making. So we got new numbers with regard to inflation. Rose at a 4% annual rate in May. That is the lowest in 2 years. So the top line number there looks pretty good. You dig into the numbers, it's a little bit more of a mixed bag. Part of what led to this slowing of the pace of inflation was a decrease in energy costs. But you still have significant increases in terms of housing that actually made up about 1/3 of the index's weighting. You had a 0.6% increase in shelter prices. That was the biggest contributor to the increase for the all items. Elsewhere, where there was significant inflation, you had used vehicle prices that increased 4.4%. Transportation services were up 0.8%. There was a little bit, Saagar, of good news in this report for workers, which is for most workers, their wages have not been keeping up with inflation. There's, it's like a little bit mixed down at the lowest end of the spectrum. They actually have been keeping up with inflation. This was the first time that overall you had average hourly earnings adjusted for inflation rising 0.3% on the month, and on an annual basis, real earnings up 0.2% after running negative for much of the inflation surge that began about 2 years ago. So why does all of this matter in the context of the Fed? They obviously are raising rates because they think that's going to be the solution for inflation. It hasn't worked all that well to this point for reasons we've discussed. Greedflation, supply chain issues, these are all things that the Fed can't really deal with. But if inflation starts to cool, they're going to feel less pressure to continue hiking rates. So that's where we are. We got a pause, but what is being described as a quote-unquote very hawkish pause, which means they're not expecting any rate decreases, and they are expecting to increase the rates in the months to come.
Yeah, and I always think it's, worth taking a step back. Like, why are we even spending any time on this? It's because it's the impact on the overall interest rates for credit cards, for mortgages, for car loans. I mean, we're seeing a record amount of debt. We've over $1 trillion in credit card debt outstanding right now for the average American consumer. And in general, we have very rarely seen any sort of real wage increase, especially whenever you factor in over the last 2 years. So to me, the fact that the housing market, we did see a cool, as in it did not go up as much, but the price did not come down on the overall supply of housing, Krystal. Same whenever it comes to the credit card debt. I mean, we expected, especially everyone was like, oh, stimulus checks and all of that. It did wipe it out for a time, but actually what's happened is a total resumption of consumer finance patterns. And we have seen a record increase with people taking out the same amount of debt, but also servicing it at much higher rates, which are going broke. Also, as I understand it, student loan, the pause that the Biden administration had agreed to in their debt, that's going to expire now in 2 or 3 months. So, some 95% of people actually did not pay down some of their debt while the pandemic was there. Obviously, there was a lot of confusion over whether the debt was going to get canceled or not. Given where we are right now with the Supreme Court and the overall administration of the project, it doesn't look like that's going to happen anytime soon. So, resumption of debt payment is also coming back. I mean, that's going to hit 40-something million households on average. It's like $200 or $300 or maybe even more per month that they weren't including in their overall household budget. So don't make this report out to seem like, oh, this is rosy and everything is fantastic. Things are still bad, at least from what I can see in the overall, the core numbers. The only real reason that things are going down is gas prices have come down, but let's be honest, they still haven't come to a very comfortable place of where they were during the pandemic or even right before the pandemic. So we still have an overall increase in price pretty much across the board. It's just not going up as exponentially as it was at some point.
Yeah, that's right. And the economy continues to be a very mixed bag. I mean, we've covered this week how there are a lot of signs of potential cracks in the economy. You've got foreclosure rates going up. We continue to follow the housing market very carefully. We continue to follow the commercial real estate market really carefully because I think that is where the largest risks for the broader economy exist. And then we also can't forget, we just had a number of bank failures of banks of fairly significant size. And maybe those are just complete outliers and anomalies because of the way that they happen to be structured and the types of clientele that they happen to focus on. But no one is really too sure about that. So that's why the Fed is treading carefully here. Up to this point, there's really been unanimous agreement about this extremely hawkish, very remarkably aggressive pace of rate hikes in recent history. There's been pretty much unanimity about it. Now there's starting to be a lot of divergent opinions on this panel in terms of what they should do going forward. The markets also responded in kind of a mixed way yesterday because, again, they were surprised by the fact they expected the pause, that the rates wouldn't change. They're keeping them high, This is not like, they're backing off. They're keeping them high. That means mortgage rates and other things are going to continue to be high. That means money is going to continue to be expensive. That continues to put the brakes on the economy. But what they were surprised about is this trajectory that was laid out, the expectation that there will be multiple increases in the future in this year, when they had even floated before, hey, maybe he starts to, pull back. Maybe they start to lower interest rates. Hey guys, if you like that video, go to breakingpoints.com, become a premium subscriber and help us build the best independent media organization on the planet.
That's right. We're subscriber funded. We're building something new. We want to replace these failing mainstream media organizations.
So again, to subscribe, it's breakingpoints.com.